Greetings, Adam Hyers here, Hyers Associates Insurance. We're a nationwide annuity broker, and today we're going to take a little time to compare bank certificates of deposit and fixed annuity accounts. A lot of people out there in search of yield, which is kind of hard to find right now, but annuities are certainly a place to look, and if you're looking at annuities, you might be a conservative investor and considering them against your bank CDs. So we want to break it down here a little bit, the difference between annuities and certificates of deposit. Both are safe and insured. CDs at the bank are insured by the federal deposit, usually about $250,000 per depositor. And annuities are insured by state, so state by state basis. And in most states, it's $300,000 per household, usually about $250,000 per contract. Certainly people have more money in CDs and banks than these numbers, but both are safe and secured. So we have some links up here when you visit our website, Hyers and Associates, where you can learn a little bit more about these. Just email us and we can tell you a little bit more. But when we look at these, rates are fixed and guaranteed for both. So they're safe on that front. You typically don't see any annuities or CDs where the rates decrease until, or increase for that matter, until the term is done. You can withdraw interest from both. So people like to get monthly interest in many occasions just to pay for living expenses. Annuities allow you to withdraw some principal sometimes, maybe up to 10% during the term. CDs don't always allow for that, so that's one difference you might see there. And of course, both are liquid to the owner at the end of the term. There's some miscommunication or misunderstandings about annuities sometimes. What happens at the end of the, say, 2, 3, 4, 5-year term? The money's completely liquid to you. You can do with it as you please. The insurance company doesn't keep your money when you have a fixed annuity. And then we look at the death benefit to beneficiaries at passing. Typically with annuities and CDs, your beneficiaries are going to keep the entire amount at passing. Now, sometimes with some annuities sold these days, you have to keep it to term to avoid any surrender penalties. So you always want to ask your agent about what happens if you passed away in the middle of the term with certain annuities. Sometimes you actually have to buy a death benefit. So that can be one place where they are a little bit different. Both accept IRAs, 403Bs, what we call qualified or pre-tax money. But one thing that some annuities do allow you to stretch the money at passing. In other words, if you have an annuity with quite a bit of money in there and maybe some tax-deferred gains, in some cases your beneficiaries can take it out over 5 years, where a lot of CDs don't allow for that. And also annuities grow tax-deferred, which is a nice feature as well. So you may not want to take any principal or interest out of your annuity at all. So anything that you keep in there can grow tax deferred in what we call non-qualified annuities, which is post-tax money. So a lot of people just put money in their annuities and set it and forget it. Maybe they do what's called a 1035 tax-free exchange every few years. That's something where you would take your annuity and move it to a new annuity and still not pay any taxes. CDs can't do any of that. So it's a little bit of an advantage that annuities have that allow you to exchange for a new annuity and avoid taxes. And then sometimes annuities allow you to add additional deposits. Now you won't see this with fixed annuities as much, but you sometimes see it with fixed indexed annuities, which are a little bit of a different animal. Sometimes those have market ties, but it's nice when you can add money to an annuity, maybe get a bonus as you add to the annuity in the first, say, 5 or 7 years. So a little bit more flexibility there. Then, of course, annuities are known for lifetime income streams, so you can take income from these at usually after the first year, or sometimes you wait till the term is over. These are deferred income annuities, so maybe you put $100,000 in and say, well, I want income 10 years from now, and I want it for 5 years, 10 years, or my lifetime. You can do a lot of very innovative things with annuity income down the road. And then certainly annuities are known for avoiding probate. You can put beneficiaries on there. You can put even trusts on there and other types of estate planning documents that allow annuities to pass on to your beneficiaries without having to go through any court system. Banks are better about that now as well, so you can see them do that sometimes as well. Penalty-free withdrawals for health expenses. A lot of annuities allow for this. So if you are critically ill in a long-term care facility, many annuities will allow you 20%, 50%, if not 100% of the principal penalty free if there is a critical illness. Not all CDs will allow for that. So if you're concerned about long-term care expenses, things like that, and having your money perhaps tied up in one of these instruments, whether it's a CD or annuity, you can ask about critical illness and nursing home waivers. A lot of people ask about annuity commissions. There's no annuity commissions. Certainly as agents we are compensated. If we help you set up an annuity, we sell you an annuity, but that doesn't take away from any amount that you put in. So in other words, let's say you put $100,000 in for 3 years, and let's say the interest rate is 2.5%. 100,000 comes back, 2.5% is guaranteed. So you know that you're getting the full amount, that you're not getting any type of haircut by the agent or the insurance company. The commission is already built in. So you know the insurance company is making a little bit more than 2.5%. Maybe they're making 2.75. That's how they pay agents, and that's how they pay themselves. Early surrender penalties, yes, certainly you want to keep an eye on early surrender penalties with annuities and with CDs. If you need to take large sums out early, let's say you have a 5-year annuity, you have 100,000 in there and you want to take 50,000 out in year 3, you're going to have a surrender penalty for that. So you want to ask your agent about any surrender penalties, and just be careful how much you put into any product that has a 3-5-year term. Certainly you wouldn't put money in there that you were planning on using to buy a house or a car or a roof. So you always want to keep enough money liquid for at least 3-6 months worth of living, and then any emergencies you might run into. But getting to the good part here, currently annuities offer some of the higher rates. We see that quite a bit. CDs right now aren't yielding very much at all. You're lucky to get 1% in a lot of CDs. Annuities do much better than that in terms of rates, and of course they grow tax deferred as well. So let's get to the good part here. If you go to Hyers Associates and you go to annuities, you see we offer all different kinds. But if you're strictly interested in fixed annuities, and those are what we see competing against CDs all the time, you want to go to fixed annuity rates, and we put them all up here. And we're going to change this, so if you're looking at this down the road, this is going to be a different metric here, a different table every single week as new annuities come out. Some increase their rates, some decrease their rates. So we have our highest 3-year fixed annuities up here. As of the making of this video, we're around 2.4% for 3 years. We talk about how the companies are rated, B++, A-, etc., how much you have to put in to create the annuity. Sometimes it's different amounts for qualified money and non-qualified money. For instance, Royal Neighbors here, they require 100,000, whereas Ocean View Life, both A- rated, only requires 20,000. So that's a big difference there. And then we talk a little bit more here about 5-year annuities. 3- and 5-year annuities are typically the sweet spot over, say, a 4- and a 6-year annuity, something along those lines. So we line them all up here based on what you're looking for, whether it's a 3-year product, a 5-year product. And then we go a little bit further down here and we go years 1 through 20. So 20, 15, 10, 9, all the way down to a 1-year contract. And you can see here, as of the making of this, 1 year at 1%. We can see around 4 years at 2.6, 5 years at 3.07. So there's a lot of different annuities out there, and typically we can find ones that are good for you. But if you're just shopping, kind of kicking the tires, and you want to see what's out there, we're always going to have these rates up here. We're going to update them weekly. And again, sometimes we're going to see some annuity companies running specials. We used to see 4% for 5 years. That was pretty common, and we're hoping that we get back to those numbers here pretty soon. So we highlight years 1 through 20, we highlight 5-year plans, and we highlight 3-year plans. So if you ever have any questions about annuities, you can just contact us, Hyers Associates. We do this work all across the United States. You see our phone numbers here. You can email us and let us know what questions you have. Thank you for watching our video, and we hope to hear from you.